Welcome to Module 5, where we can discover the budgeting theme in Business Plan. The agenda of the Module 5 envisages addressing important issues such as the main elements of budgeting and startup budgeting, the preparatory activities, the process, and the startup requirements. Different types of budget: direct production budget, direct materials budget, direct labor budget, overhead budget, and important definitions like discretionary versus fixed costs, break-even analysis, break-even point. We may also see examples of budget formats that will help us in drafting a possible cost framework. A budget is a formal written statement of management's plans for a specified future time period, expressed in financial terms. Its benefit are in terms of management. It requires all levels of management to plan ahead and formalize goals on a recurring basis. Performance. It provides definite objectives for evaluating performance at each level of responsibility. Warning system. It creates an early warning system for potential problems. Coordination. It facilitates coordination of activities within the business. Impact. It obtains results in greater management awareness of the entity's overall operations and the impact of external factors. Motivation. It motivates personnel throughout organization to meet planned objectives. In the frame of budget components, we must take into account the startup requirement, profit and loss budget, assets and liability budget. There are many types of budget that may be prepared in a business plan, depending on the business type, the stakeholders of the business plan and its goals. Documents produced while launching a new business or a new business unit are partially different from the usual output produced by an existing company. The process is harder, since no internal historical evidences are available. In the case of existing companies, the budgeting process has short-term timing. It is less complex, based on intern and historical data and performance. It benefits general management and functional managers. It has a certain roadmap to long-term strategic goals. It is less complex in general. In case of new business, or also new business unit, the budgeting process needs a complex business plan that includes content, main business goals, people to be involved, timeline, as well as many variables, mainly external and previsional, medium, long-term planning, founders and forecasting. It requires very hard work. Budgeting requires previous market analysis, marketing plan and business goals definition. If the previous steps of the business plan are well developed, it becomes easier to set up economical and financial information. A first document highlights the costs and funds required to proceed with the startup. Then a revenue model and a list of costs should be prepared in order to analyze the feasibility of the business model. Formal statements such as income budget, balance sheet, cash flow are needed if the business plan is expected to be submitted to investors, bank, business angels, grants. The first step of preparatory activities. The marketing plan and the market analysis are very important to understand general economic conditions, industry and technological trends, advertising and promotion. The market research studies can help us to know the expected market share as well as the pricing strategies. The second step of preparatory activities. Now we can design the timeline of the main activities that have to be done in order to launch the business. The third step of preparatory activities. Then we can see all the startup requirements. In general, the first startup expenses, fixed and monthly costs, the startup assets, owner funding, loans and others. Calculating business startup costs should be a part of starting any business. No matter what kind of business you intend on owning, it is a good idea to estimate your business startup expenses prior to jumping in. You may be surprised at the total startup cost. Nearly all new business owners underestimate the cost of starting their business, leaving it exposed to the risks of being underfunded. Of course, these costs are then required in the business plan, loan or grant application. They are also helpful when putting together pro forma financial statements. Funding sources. Start by listing the sources of funding that you believe will be available to you. This would include money supplied by owners and investors, funds available from bank loans or other lines of credit. In some cases you may be pursuing other sources of funds such as grants, endowments or sale of assets. Fixed costs. After all your funding sources have been outlined, start putting in the estimated fixed costs. These costs are one-time costs associated with getting your business up and running. This includes things like leasing space, purchasing assets, stocking up on inventory, and getting your legal and marketing issues in order. The key to putting together accurate numbers is to get into the details. This requires doing detailed research by calling suppliers and providers, searching the internet, and listing any and all costs that may be applicable. Two key parts to the fixed costs are the working capital and a reserve for contingencies. These can be significant. Any startup is advised to have a contingency fund, as there are always last-minute surprise costs and fees. Consider the risks of your business and set aside sufficient funds accordingly. Be sure to include enough working capital to fund your normal business operations as you grow. Remember that there can be a significant amount of time between when a sale is made and when you actually receive payment. Sufficient working capital is needed to allow you to continue to purchase inventory and pay bills while waiting for payment. More than one growing business has failed because it lacked sufficient working capital. See cash flow document, monthly costs. Until profitable, many entrepreneurs fail to understand that businesses are seldom profitable the first day. In order to have a clear picture of actual cash required, it is important to estimate your monthly operating costs as well as how many months it will take you to move from the red to the black. Try to identify how many months you believe it will take to get up and running and fill in the estimated monthly costs. The sales budget is the first budget prepared. It is derived from the sales forecast and the marketing plan. The sales forecast is management's best estimate of sales revenue for the budget period, monthly and/or annually. Every other budget depends on the sales budget. The example reported in the next slide, we report the unit cost of sales. Evidences to complete this field will be analyzed in the production budget session. A sales forecast is an essential part of a business plan. It is also essential if you are looking to get a bank loan or investors. It is useful to analyze and forecast the unit sales, growth rate, profit margin, and gross profit for your products and services. In a business plan or presentation, you should probably use a chart to help communicate your forecast. Considering the sport and tourism sector, please note that in order to complete the sales forecast, you should before have analyzed the demand seasonality and established a price policy that should not be linear in seasonal business. All these considerations should be clarified in the marketing plan. Forecasting in a startup business may be really hard. Two important points. Identify the key variables influencing your business performance. Try to identify at least 3 scenarios: best case, worst case, and a middle way case. Scenarios come from the changing in these variables. This is an example that reports the unit cost of sales. Evidence to complete this field will be analyzed in the production budget session. The production budget shows the units that must be produced to meet anticipated sales. It is derived from the sales budget plus the desired finished goods. Required production in units formula: budgeted sales units plus desired ending good units. Beginning finished good units equals required production units. After determining the number of units to be produced, we can budget for the following: direct materials, direct labor, and manufacturing overhead. Direct costs are useful to complete the sales forecast by estimating the unit cost of sales. The margin provided by the net sales should be enough consistent to cover indirect costs and taxes. After considering costs, we will have all the necessary data to set up the income statement, profit and loss budget. After determining the number of units to be produced, we can budget for the following: direct materials budget, direct labor budget, direct labor budget. Direct costs are useful to complete the sales forecast by estimating the unit cost of sales. The margin provided by the net sales should be enough consistent to cover indirect costs and taxes. After considering costs, we will have all the necessary data to set up the income statement, profit and loss budget. Direct materials budget. The direct materials budget shows both the quantity and cost of direct materials to be purchased. It is derived from the direct materials units required for production, from the production budget, and desired ending materials inventory. This budget is quite more significant in a goods business rather than a service-oriented business. Direct labor budget. The direct labor budget shows both the quantity of hours and cost of direct labor necessary to meet production requirements. Please consider differently regular labor and seasonal labor. Overhead budget. Overhead budget includes manufacturing, selling and administrative overhead costs for the budget period. It contains all costs other than direct materials and direct labor. Now summarize the main important formula: direct materials budget. Direct materials units required for production plus desired ending direct materials units. Beginning direct materials units equals required direct materials units to be purchased. Direct labor budget. The total direct labor cost formula is units to be produced, direct labor time per unit, direct cost per hour. Here we are some examples of overheads budget, costs. The administrative salaries line item contains the wages paid to manufacturing supervisors, the purchasing staff, production clerks, and logistics planning staff. Depreciation expenses, i.e. that portion of a fixed asset that has been considered consumed in the current period. This amount is then charged to expense. The intent of this charge is to gradually reduce the carrying amount of fixed assets as their value is consumed over time. This is a non-cash expense. That is, there is no associated cash outflow. Freight and supplies expenses, usually closely linked to actual production volume, and so their amounts fluctuate in conjunction with planned production levels. Rents and utilities, which are usually considered as fixed costs. Sales commission and advertising, etc. Pay attention to distinguish between fixed, variable and mixed overhead costs. Variable costs increase as production increases. Contrary, fixed costs are stable and not related to the level of production. Mixed costs have both a fixed and a variable component, i.e. energy costs. Distinguishing fixed and variable costs allows to set up flexible budgets and to calculate the break-even point. We will deal later on with these two topics. Discretionary versus fixed costs. Many fixed costs are really discretionary costs. They are budgeted as fixed costs, but if, for example, the economic conditions look bad, these costs can be reduced. Examples: maintenance, advertising. Discretionary fixed costs should be distinguished from committed fixed costs, like rent on a factory building, which are required to run the firm. Budget income statement. An income statement or profit and loss statement is an essential financial statement where the key value reported is known as net income. The statement summarizes a company's revenues and business expenses to provide the big picture of the financial performance of a company over time. The income statement is typically used in combination with a balance sheet statement. The budgeted income statement is prepared from the operating budgets, sales budget, production budget, direct materials budget, direct labor budget, manufacturing, selling and administrative overhead budget. There are many ways to format an income statement. The two main formats are 1. The simplified, single-step, 2. The multi-step, or contribution margin format, income statement. Essential values. Revenues. The income that is generated by providing a service, selling a product, earning interest on investments, renting extra office space, licensing technologies, selling advertising space, or licensing the use of your brand name. In the income statement template, there are categories for sales revenue, service revenue, interest revenue, and other revenue. You will likely want to customize the revenue section to highlight your company's main sources of revenue. Cost of goods sold, COGS. The cost of goods sold can be calculated by adding beginning inventory, goods purchased, raw materials and direct labor for goods manufactured, and then subtracting the ending inventory. Income from continuing operations. This is the bottom line, calculated as the operating income minus interest expense and income tax, and plus, minus non-operating revenues, expenses, gains, and losses, if there are any. If there are no below-the-line items, then this is the same as the net income. Break-even analysis, break-even point. This analysis is a common tool used in a solid business plan. The formulas for the break-even point are relatively simple, but it can be difficult coming up with the projected sales, selecting the right sale price, and calculating the fixed and variable costs. The break-even point is usually either the number of units you have to sell or the dollar amount of sales required to cover your costs. It may also be defined as a. The point at which an investment will start generating a positive return. B. The point at which total costs equals total revenue. C. The payback period, or the amount of time required to break even. The formula used to calculate a break-even point, BEP, is based on the linear cost volume profit, CVP, model. All the different types of break-even analysis are based on the following basic equation. The chart shows the break-even point, BEP, as the intersection between the total revenue and total cost when plotted with the number of units on the x-axis. The profit, or loss, is also shown on the chart as total revenue, total cost. Basically, it says that by selling 100 units, and getting a turnover of about $1,000, all costs will be covered, fixed plus variable costs. If more than 100 units will be sold, there will be a profit. In the case of a startup, first months or years of profit will be used to pay for startup investments, payback period. Under a marketing point of view, it allows you to decide how price policy, or discount policy, may affect profits or losses. Now let's see together some format. The budget income statement. 1. The simplified, single-step, income statement groups all of the revenues and expenses, except the income tax expense. Depreciation. The cost of business assets can be expensed each year over the life of the asset. Amortization and depreciation are two methods of calculating value for those business assets. The expense amounts are subsequently used as a tax deduction, reducing the tax liability for the business. The contribution margin format. 2. The multi-step, or contribution margin format, income statement breaks out the gross profit and operating income as separate lines. It first calculates the gross profit by subtracting cost of goods sold from net sales. It calculates the operating income and then adjusts for interest expense and income tax to give the net income. Please note that the expensive section could be even more detailed by highlighting labor, administrative and sales expenses. Operating income, EBIT, earnings before interest and taxes. Balance sheet. The balance sheet is a very important financial statement that summarizes a company's assets, what it owns, and liabilities, what it owes. A balance sheet is used to gain insight into the financial strength of a company. You can also see how the company resources are distributed and compare the information with similar companies. The balance sheet informs company owners about the net worth of the company at a specific point in time. This is done by subtracting the total liabilities from the total assets to calculate the owner's equity, also known as shareholders' equity, for corporations, or simply the net worth. The term current in a balance sheet generally means short-term, which is usually 1 year or less. Please note that total assets equals total liabilities plus owner's equity, always. Current assets. The term current in a balance sheet generally means short-term, which is usually 1 year or less. Common current assets include cash, coin, balances in checking and savings accounts, accounts receivable, amounts owed to your business by your customers usually within 10 to 60 days, inventory, goods for sale, and prepaid expenses, like insurance and rent. Long-term assets. These assets include long-term investments, cost of property and equipment, like land, buildings, equipment, tools, furniture, computers, vehicles, etc., offset by accumulated depreciation, intangible assets, like patents, contracts, trademarks, copyrights, and goodwill, and other assets, like deferred income tax arising from the loss of value of property that cannot be reported as a tax deduction until the property is sold. Current liabilities. These include the obligations to be paid within 1 year, including accounts payable, short-term loans, income taxes payable, wages, unearned revenue, e.g. service contracts, and the current portion of long-term debt, e.g. mortgage payments payable within 12 months. Long-term liabilities. These include long-term debt, e.g. notes, mortgages, capital lease obligations, e.g. leases structured as loans, and deferred income tax, e.g. the tax due on the increase in value of an investment security that isn't paid until the security is sold. Owner's equity. This is basically the amount left over when you subtract total liabilities from total assets. It includes the owner's investments and retained earnings, the portion of the profits reinvested in the business. Cash flow budget. The cash flow statement summarizes a company's inflow and outflow of cash, meaning where a business's money came from, cash receipts, and where it went, cash paid. By cash, we mean both physical currency and money in a checking account. The cash flow statement is a standard financial statement used along with the balance sheet and income statement. The statement usually breaks down the cash flow into 3 categories including operating, investing and financing activities. A simplified and less formal statement might only show cash in and cash out along with the beginning and ending cash for each period. While used in budgeting, cash flow analysis estimates or plans for future cash flows. This is important because cash flow is about timing, making sure you have money on hand when you need it to pay expenses, buy inventory and other assets, and pay your employees. Thank you for your attention. Now, let's go to the final test.